What Your Bank Doesn't Tell You, a podcast by YouMushroom.
Dear community, welcome to our podcast series, What Your Bank Doesn't Tell You. Today we're going to cover a very interesting topic, trends in the ETFs. And accordingly, we have a valuable guest, an expert in this field, heading the ETF department for Invesco in Switzerland. Nima, welcome.
Yeah, thank you. Thanks for the invitation, Luba.
Nima, ETF is a topic which we've been discussing over years, and we've also been discussing the lack of ETFs as we know it from our beginning in the financial industry. If we have to briefly tell our community what is an ETF, could you give us a brief definition?
Yeah, I mean, ETF stands for Exchange Traded Fund. So it's like a mutual fund that you can trade on exchange intraday. And it's very easy. It replicates an index, such as the S&P 500. ETF stands for transparency and being cheap. Yeah, that's also a big advantage of ETFs. So it was more than one word, or
no, that's great.
Yeah.
That's perfect. And I remember when I was starting to invest and doing my first exercises into investing in 2021, for example, there was no opportunity to buy really an ETF back then.
Yeah.
If I wanted to invest in the broad Swiss market index, I remember SMI has been around since 1988. I remember we were computing how many stocks do I have to buy and the initial amount which I have to invest.
Yeah.
Which would have been back then, I don't recall correctly, but just to put it in some kind of perspectives, probably around 5,000, 6,000, something along those lines. Yeah. And today it would be 10,000, 12,000 if I want to, even more, depending on how the market is moving, as opposed to just putting 10 francs and replicating it with only 10 francs.
Yeah, I mean, if you look, there are indices like FTSE All World, MSCI World, for instance, where you can invest from 5 francs into the entire index, which is 4,000 companies, 50 countries, with 5 francs, which is actually the beauty about ETFs. You are diversified, invested into the market that you select without choosing and picking a single security.
That's great. And we can say in a nutshell that for very little money, barely any fees,
Correct.
You actually can invest in a broad variety of stocks and get diversification.
Correct. That's a good summary.
Well, and can I ask you one thing? Because I remember 2-3 years ago when we've been discussing, the saving plans were not a topic in Switzerland. They were simply not existent. We had them in Germany, and Germany has been a pioneer in this sense. US, of course, they know that since ages because the pension fund system is completely different than ours. But why do you think were we so slow in introducing ETFs? What would be your perception about that?
Why we were so slow? That's a tough question. I think, to be honest, in comparison to Germany, the Swiss banks are very strong, and it is usually more profitable to say that way to sell active funds for banks. So ETF is not. That's of
There's not
interest.
a lot of margin, right, for the banks as well.
So if you look, I mean, S&P 500 for 5 basis points, there's no margin, literally. So I think that was one of the aspects. The second aspect was the Swiss pension system is pretty good. So you have 3 pillars, the first pension system, second, and the third pillar. So I think that was a reason. And then the third reason is the Swiss market is not part of the EU. So it's tougher with the regulations for many institutes that are working in Germany, for instance. For them, it was a hurdle to enter the Swiss market, or they even entered it and exited the Swiss market again. So these 3, and then the fourth factor is actually around many investors, many platforms saw the Swiss market as a small retail market. So I think it's a combination of the 4, to be honest, which made it so slow for the Swiss market to enter the saving plans.
I see. Thank you very much for this very thorough answer, and I see exactly the same way. Plus, as you mentioned, for the retail market, for example, there was quite a period of time where we didn't have the so-called neo brokers, which we have in Germany,
true.
right?
True.
And now we're having Neon, we're having you. Of course, Swissquote is also moving in this direction. So there are a lot of players who can afford opening an account with basically very little cost or even zero cost, enabling saving funds with basically also zero transaction fees or very little or low transaction fees. Huge advantage if you want to put 10, 20, 50, 100 francs aside per month. I think that is this technological change which makes it.
Yeah, I mean, for that, actually, as you correctly say, we did start with Neon, which is a neo-bank. Then the follower was you. Now we have also traditional banks with PostFinance entering the market. So now it's getting more and more traction of traditional players as well. But sometimes you really need bank challengers. That's also how neobanks are called. They challenge the traditional status quo. Yeah. And I think that was needed for the Swiss market. And with Neon and you, we have two challengers of the traditional banks. And that enabled to then go live with the saving plans.
I agree. And luckily, it's already a fact that we have also saving plans here in Switzerland since the beginning of this year, we can say.
Yeah, we do. And numbers are quite appealing. And if you look also the saving rates, it's around 450 francs.
Oh, wow. That's
per
a
person,
good average.
which is a really good average. If you compare it to the German market, it's around 165 in Germany, euros. So it's more than twice the size of the German market. And then that's exactly the point. The retail market with around 10 million is small, but if you look at the income and also the cash which is on the accounts, it gets a decent mid-sized retail market, which is then appealing also for platforms and to be active in a saving plan market here.
Absolutely. And what trends do you see in the field of saving plans based on ETFs? Do you see certain topics dominating or certain styles? So if there is a characteristic you see that's quite prominent, what would it be from your observations?
I mean, what the highest rates go into global equity exposures of the saving plans, which is like a FTSE All World or MSCI World. So that's actually what we see most into the saving plans. Why? Because it's easy. You just pick one global equity exposure. The risk is rather limited due to the high diversification. But at the same time, we do also see investors who then tend to have a satellite approach around this FTSE All World that they selected via themes, be it megatrends, be it blockchain, as an example, be it maybe also sustainable investments that we do see as well, or in the end, in topics like AI, cybersecurity, which are selected as well. So it's really mega trends, themes you can select, and then the core really global equities.
That is very interesting. And for our community listening out there who are not familiar with the expressions, MSCI World and FTSE All World, those are global equity indices, right?
Yes, that's correct.
And if I recall correctly, FTSE All World is covering, as you mentioned, also already above 4,500.
Yeah, that's correct. Yeah,
quite a lot of equities from almost 50 countries, right? Developed and emerging markets, and MSCI, pretty similar picture. I think it's a little bit less. It's, I think, 2,700, roughly along those lines. But also a mix between emerging markets and respectively developed markets. In terms of styles and strategies, there are some new trends, new kids on the block, as we say, which we observe. Would you like to tell us some few words about those too?
Around active ETFs? Yes. I mean, that's an interesting topic that is coming over from the US to the European market. So what means active ETF? It's, first of all, we need to define what it means. Either it's a high conviction strategies, fundamental bottom-up based active management. That's one way where you can see active. The second way is really around enhanced strategies. We are very close to your benchmark. With a factor overlay, you try to be a bit better than the benchmark, but not taking too many risks and deviations towards a traditional benchmark. Or you say it's a systematic approach, a thematic approach, where you partner up with specialists in a field. They do screens around how much revenues are coming from the blockchain area, for instance, and these type of parameters. So these are the three, I would say, areas of active. And then there's a fourth one which comes around in the fixed income space, where you give the PMs, they track an index, but then some active elements that they don't need to stick to the benchmark due to rebalancings, etc., where they could have otherwise difficulties of creating and redeeming. So that's quite technical. But the high conviction area, I would say that will be a tough one to replicate in ETF format. Why? Because in Europe, you have to have the transparency. And if you think if there is a portfolio with 20 stocks, most of the active portfolio managers, they don't want to disclose on a daily basis the 20 names, right? Because they could be front running and these type of things, or the portfolio could be mimicked, etc. So that's a problem of high conviction, bottom up based active ETFs. The enhanced or the access tools where you get various themes with an active element definitely makes sense, yeah, because if you give the portfolio manager behind the ETF some flexibility of trading, it is definitely an added value for the investors. And so there is not a right or wrong. It's just for what path am I looking for active? And in that respect, then you need to see, okay, is this the right strategy I want to select? So yeah, long words, but in the end of the day, it is like every investment. You need to look into it. It needs to fit into your portfolio. And yeah, so I would say that's definitely a trend to look at. But at the same time, you need to see if it really evolves in the European market as well, as it did in the US. In the US, you have tax advantages in ETF wrapper versus the mutual fund. So that's also a big reason why we see huge flows in the US market in active ETFs. These tax benefits we don't have in the same way as in the US. And so I think active ETFs will have their place, but the core of the flows will still go to traditional beta. Yes, correct.
Super interesting. Thank you for this very interesting and insightful explanations. And it actually comes back right to the topic: on which markets can you create alpha or this extra yield above the average benchmark? And as benchmark, we normally use the large stock indices of the US equity market, like S&P 500 or NASDAQ 100. In Europe, we have Eurostoxx 50, SMI for Switzerland, DAX for Germany, etc. Or worldwide would be MSCI World, FTSE All World. So the question is, in which markets can you create this extra yield over the average yield, what we call alpha in our jargon? And there is this often disputed fact in economics among scientists and empirical studies that liquid markets don't really offer opportunity for systematically creating active alpha. Hence, further on, as you say, the regular plain vanilla ETFs as we know them, tracking an index, or the beta ETFs, they're going to stay.
Yeah, I mean, the more efficient the market is, the tougher it is to generate alpha. I mean, and that's specifically for the US market over 10 years. You don't find any, I think there's really literally no active manager that outperforms the S&P 500 over the full 10 years cycle. So it's impossible. But then, as you say, if you go into the small cap space or in niche emerging markets, yeah, clearly you can add alpha. But then in an ETF wrapper, the question is how concentrated is the portfolio? If it's a broader portfolio that is managed actively, that's okay. But if you have a 50-name portfolio, I'm not so sure if the portfolio manager wants to have it in ETF wrapper with daily transparency, daily liquidity.
You're right, because then you actually kind of give away in advance
Correct.
a lot of the technical, a lot of the, how shall I say, competitive advantage by constructing the portfolio.
To competitors, to hedge funds, etc. Yeah.
And portfolio managers, it's fair to say that in this context, they actually act as better researchers, right? Because a lot of the small caps, for example, they're not covered by the same amount of analysts as we see on the largest stocks on the market. Like an Apple would be covered by, I don't recall correctly by heart, but I think it's somewhere between 40 and 55 analysts, somewhere along those lines.
Yeah.
And if you take a small cap in the US, you're probably far below 10 analysts per name. And you don't have to look, we have that on your mushroom, it's very easy to select per number of analyst ratings, and it's scary how many stocks worldwide are actually covered by less than 5 analysts.
Yeah, but that was in the past different. In the past you had a lot of sell-side research.
Yes.
Because since the regulation changed and you have to pay for research, the number of researchers has decreased quite substantially. So as you correctly say, some areas are not really research anymore as much as they were done in the past.
And as they used to be, yes.
Yeah.
Absolutely. We were fixed maturity ETFs.
Yeah.
Could you spend some words on this topic?
I think it's a super interesting topic. It's over a decade, there are fixed maturity ETFs in the US already. And the concept is the following. You have a basket of corporate bonds. For instance, US dollar IG, or IG stands for investment grade, or Euro investment grade, which could be around 300 to 400 corporate bonds with a fixed maturity date, let's say 2027. So it is the same way as if you would buy a US dollar corporate IG bond that matures in 2027. But here you buy a basket of many names in one ETF. It behaves exactly like the single line bond, like the corporate bond. It has the payouts every quarter. And in 2028, December, you will get the complete payout and redemption. It is actually quite interesting because you exactly can lock in the yield. In the moment you trade, you know, okay, my yield in US dollar terms is, for instance, 4.5% by that time period annualized. And so you could, for instance, if you know, I want to travel in 2027, or I want to finish my studies by then, to calculate cash flows on that side and say, okay, I need 5,000 for my university tuition fees. And you know, if I invest that amount into this fixed maturity ETF, that will be in December paid out. So it's a way you can match your liabilities via an ETF. And I think it's for the retail market very interesting, who have exactly these payouts via different time periods. But also for professional investors, it's a very interesting tool because you can pick and time the different maturities quite nicely via the fixed maturity ETFs. So it's a new construction that we have in Europe. A rather old construction in the ETFs all over, if you take the US market into account.
And it's a very good way to manage liquidity, right? If you have, as you correctly say, if you have, like, for example, liquidity which you need to deposit somewhere.
Correct.
What are the alternatives? You put them on a saving account, or you buy a money market fund or ETF, or you just pick up a bond and then invest. But a single bond position, like at least here in Switzerland, very often the level of entry is 50,000, 100,000.
That's true.
The denomination is very high, as opposed to ETFs where, and there you also, if you buy a regular bond, like you have a concentration risk, right?
Correct.
But if you go to a constant maturity ETF, you don't have the concentration risk because it diversifies the credit risk among several baskets, several bonds in the basket. Plus, you can start with much less than the regular ticket, which you need to pay for the for a bond.
That's correct, yeah. So,
And what's interesting also from another perspective is it makes the bond markets more transparent, more liquid.
Yeah.
Because currently the bond markets are still preserved, at least in Europe, for if you don't go through actively managed funds or ETFs, bond markets affect on a single name
yeah,
for the high net worth
that's true.
individuals
That's true.
or professional investors.
No, I mean, in the Euro space, as you say, sometimes you have ticket size of 100,000 euros.
Yep.
And here in the ETF, you invest into into these bonds, but the ETF ticket size is around 10 euros.
Yeah.
So that's the beauty.
game
So it's
changer.
diversified, no minimum, and it's similar, very similar to a deposit actually.
Yes, it's a basket of deposits.
Correct. Yeah.
Well, with credit risk, obviously.
With a credit risk,
but
yeah, that's correct.
deposits
Yeah,
also do
that's true.
have.
But you get a better yield. Yeah. Yeah.
And that comes from the credit risk. No, that's super interesting, and we're looking forward. Well, but be curious also to go through those type of products in a deep dive. For another topic, which very often, and at least we discuss a lot with our students in our educational program, is the weighting of the standard indices.
Yep.
I'll take an example, SMI. Our evergreen. SMI, which is our local benchmark of the 20 largest Swiss stocks listed on the Swiss Stock Exchange, has a very high concentration. Nestle is just below 18%. If they continue losing market capitalization like that, that would naturally, obviously, decline as well. But around current levels is around 17 point something. There is a cap in the SMI that per stock it should be, I think, 18%. But then the next two, Novartis and Roche, make 30% of the in total of the index, and those are two chemical companies. So we have a very high concentration in two companies of actually almost 50% of the index is moved by two companies. This is a problem in a lot of ETFs, right?
That's correct.
What can a regular user do against that concentration risk?
I mean, it is a risk because you invest into these names. In the end of the day, that's the market cap weighted index. Yeah. So if you invest the market cap weighted index, you take these risks. There is, of course, a possibility to invest into equal weight indices, for instance. What does it mean? It means from the S&P 500, for instance, or Nasdaq 100, or even MSCI World, all the companies are equally weighted. Which means you sell every month, so to say, to make it in easy terms. You sell those companies that performed well, and you buy those ones which got cheaper, so performed less. And in that approach, you have a higher tilt towards smaller cap names, and you underweight the larger cap names. And like this, with this approach, you diversify, of course, the portfolio further. The risk is obviously if market cap weighted indices perform better, you have an underweight towards technology, for instance, which is at the moment or has a very high weight. But if you look, I mean, also US, for instance, if you take their MSCI World equal weight, you have, of course, an underweight towards US. But if you look in the past, I think it was in the 80s, Japan had one of the biggest weights because they had very big companies. And every 10 years, there is a move of the big names of the top 10 weights, also of the countries, etc. So being invested equal weighted over long term should actually pay off. But over the last few years, it was tough because the market cap weighted indices performed very well, and the companies out of the market cap weighted in the indices got bigger and bigger. Yeah, but there is a tool which is called equal weighting. Yeah.
Super interesting. Yes, it's true, and it has pluses and minuses.
Yeah.
And given that we are now at the topic concentration, which you can actually also have with an ETF.
Yeah.
There is no such thing as a perfect instrument, right? And we're talking about concentration risk. How about the topic concentration in the global world indices with respect to certain regions?
I mean, the highest concentration is the US market. I mean, if you take North America, which is US and Canada, you're exposed to around 60% to these two countries, basically. And But at the same time, that's where the growth comes from. If you look at the Nasdaq 100, you have literally in that index most patents of the world and the most R&D expenditures. So it is really an index that is investing into the future as well by R&D and patents, etc. But at the same time, yes, you have a high concentration risk towards the US market. But what can I say? I mean, that's the risk you take with market cap weighting.
Absolutely, and it's a question of becoming aware of it. And as you correctly say, it's justifiable in the sense that indeed the most value creation happens in the USA currently, at least in the stock markets.
Correct.
With respect to the fact that it's entirely driven by technology and AI.
But what is important is really, yes, you invest into US companies, but these US companies, they have revenues all over the world.
Yes.
So you're exposed not only to the US dollar, you're exposed to multiple currencies where these companies are generating their revenues, and at the same time you're exposed also to those countries where they have revenue generation. Yeah, so from that perspective, yes, you are invested in the US, you're invested in US companies, but you're invested in 99% of the time, if you take the
companies.
It's global companies.
You're right, and probably the angle which mainly weights strongest on the performance is actually the currency effect, right?
Correct.
Also, Nestle is such an example. Nestle is a global company, and you don't really have you have practically a very certain percentage of revenues created in Switzerland, but the majority is US, Europe, Latin America, Asia, and where you got the exposure to their own countries because the official currency in which they report is Swiss francs, and you have the currency effect.
That's correct.
And for our community out there who are not familiar with the expressions MSCI All World and FTSE All World, here a brief explanation. As you mentioned, Nima, FTSE All World is an equity index tracking practically more or less the whole liquid universe of stocks globally. And we have roughly 4,300 names represented there. And MSCI All World is a similar concept, also representing stocks from the globe. And there we speak about roughly 2,700 individual company names represented in the index, just to give you a little bit of a flavor what's behind those expressions. Well, it's a tradition in our podcast that our guests get a question, which our previous guest on our previous podcast series would post. And in this case, Nima, you're having a question from Professor Thorsten Hens.
That's a tough one, I guess.
It's going to be a challenging one.
Must be.
So we're going to have it replayed.
Hi, Nima. Thanks for doing a podcast with you, Mushroom. So we are brothers. So I'm currently working on gold. And since you're an expert on ETF, I would like to know whether holding gold in an ETF is better or holding it physically.
There you go, Nima.
Asking the ETF expert if an ETF is better. What do you think I would say?
Testing subconscious and conscious bias.
No, I mean, okay. The problem, they're both camps are fine. Physical gold is very good to hold, but at the same time, ETFs are very good as well. And I tell you just why. The point around holding ETFs, gold via ETFs is, first of all, the storage costs are obviously cheaper because you store billions with many others. Yeah, so storage is cheaper. You can trade it a lot easier. Yeah, it's on exchange. You pay a few bips to trade, so it's a lot cheaper to trade the gold. You have it in your portfolio. You don't need to carry the gold. So if you want to travel somewhere, for instance, and then fourthly, it's around safety as well. I mean, if you have the physical gold in your home, there is a risk to keep it physically, right? And so basically, in the end of the day, the cost factor is one thing, pro ETF. Safety, I would say, is pro ETF. The drawback for the ETF is you can't see it. Yeah, you can't carry it and show the gold bars to friends. But so that's the drawback. But other than that, I would say it's really better to have gold in a physical format via an ETF, because you can get it delivered as well. Actually, that's the beauty about physical backed gold ETFs. Yeah, long answer. I'm pro holding gold in an ETF format. But yeah, if you want to have it physical, that's okay as well. Why? For instance, if there is a huge war, there's no transactions, exchanges are closed, then you cannot sell your gold ETF.
But it's better to have potatoes, no?
Yes, that's true, because you cannot eat your gold. That's true. That's true. That's true.
But it's true. I mean, it's probably a mixture, as you say.
Yeah.
Both have plus and minuses, and physical gold cost storage. Then again, you have the same with a paper ETF. Paper ETF, if you want to get it really, the gold question is what time to deliver you're going to have.
Yeah.
But yes, probably a healthy mixture of both would diversify the operational risks. Let's put it that way.
It's really just operational risk, correct? But then really everything needs to be shut down to have this risk. Yeah,
it's true, and absolutely. It's an interesting metal, by the way, and it's still very popular. I mean, I don't know when the whole monetary system in coin form started. Probably already Asian Mesopotamia was trading in this. Well, back then they had the barter economy, right? The exchange, but at least the Greeks, the ancient Chinese and Indians, they used to have already coins out of gold and silver. And it's amazing that even now we still are into this topic. We have in our team, by the way, two kind of camps: Camp Crypto and Camp Gold. I'm Camp Crypto, but
both would have been good.
It's true. Yes, that's true. Actually, that's very true. Maybe a brief summary. What would you give on the way to our community? 3 takeaways that they should really always consider when they pick up ETFs or when they think about ETFs.
Yeah, thinking about ETF, it's really look at the replication, because physical replication is very good, but synthetic is very good for US equities because you have a tax benefit on that side. That's one thing. The second thing is around size. I wouldn't take really too small ETFs, because sometimes too small, I mean like 3, 4, 5 million, because they could be closed. Yeah, so that's a bit painful from time to time.
What would be a good size threshold, or is it difficult to say? What would you?
You could, I mean, around 50 million-ish. That's
an ETF should have around. Okay.
It could be. I mean, 2 to 5 million is a bit small.
Tricky.
Yeah. But 50 million.
50, 100, above 100 to your.
Yeah, for sure.
Then
I mean,
really,
50 million
really.
is fine as well.
Okay.
Yeah. And then, so it's really a replication method, and it's really around the size. And then in the end of the day, invest long term, I would say.
Yes.
And don't time the market too much. And for that, saving plans are a great vehicle that we have nowadays, also in Switzerland.
This is exactly the point. The saving plans, they take away one big sorrow and a mistake, which I also did back then when I was starting investing. I thought there is a perfect market timing. There's no such thing. Time in the market really beats market market timing. So that is a very good, on that note, a very good closure. Dear Nima, thank you for your time. It's always a pleasure to have you as a guest on our podcast. And one last thing, the question for our next guest.
Oh, yeah. So what was your best investment and what was your worst investment ever? So that's my question to the next speaker.
That's an excellent question, and I'm pretty sure everyone can answer that. All of us have some super investments and less good investments.
Usually people forget about the worst investment.
That's positive bias.
Yes.
That's true. Thank you for this question. I'm sure the next guest is looking forward to answer it. And dear community, thank you very much for your attention. Nima, thanks again.
Yep. Thanks, Luba. Thanks for the invitation.
And as always, write us at hello@mushroom.com in case you have any questions, remarks, inspirations, Happy to hear from you. Thank you and goodbye.
Bye-bye.
What Your Bank Doesn't Tell You, a podcast by You Mushroom.